Hey, it's Stuart. Investors in the Australian share market, particularly the Australian share index like the ASX 200 or even the ASX 300, for instance, which you can access really cost effectively with stocks like A200 or VAS, a Vanguard fund or a Beta Shares index fund. Very cheap way to invest in the Australian market. The problem, though, is, or the thing that you need to think about is that the index will be heavily influenced by only a handful of companies. And so when we invest in an index or we use a market cap approach to investing, we naturally need to really think about how will these major companies, the companies that are going to have a pretty impact or could have a big impact on the index, how are they going to behave over the next period of time, and where are the returns going to come from? Also, quite often we have clients that might hold some direct shares, shares that they purchase before they become our client, because of course we don't advocate investing in direct stocks because that's not aligned to our evidence-based approach. But we then need to think about, we don't just go and sell those stocks, we try and divest of those shareholdings in a strategic way to try and maximize value, of course. So today I wanted to talk about, the big banks and the big miners in Australia, and then maybe some of the other companies that make up or round out the top 10. And I think it's a good conversation to have and a good thing to think about, because if I'm investing in an Australian share index, I need to understand that my returns and outcomes, particularly in the shorter term, can be influenced by some of these very large cap stocks. So let's talk about the most valuable stock on the ASX, and that's CBA, Commonwealth Bank. In fact, Morningstar said earlier this year it was the most expensive bank in the developed world. Now, we think internally, we've been running a mortgage broking business for a couple of decades, we think CBA deserves its premium. That is, it should be valued on higher metrics than its peer banks, because its technology system is really good. It has 25% of the mortgage market, the largest share. It's got over 17 million customers. That's like 64% of Australians are customers of the bank. So it's got a huge franchise, and its systems, processes and technology and focus on customer outcomes and customer experience, I think are better. Not perfect, but better than the other banks. So yes, it deserves a premium, but it's trading considerably high at the moment. A forward PE of 24 times, which, if you look at historic averages, it's really been between 16, 18 times earnings. So it's sort of 30% above that sort of long-term metric. And it looks a bit overvalued. So if you're holding CBA stocks or you're investing in an index that has, more than 10% allocated to CBA, which your traditional index fund will, that is a bit of a risk. Now, it had a stellar performance last calendar year in 2024. What's the chances of it having a stellar performance in 25 as well? Look, I just think, and we think internally, that the downside is much more significant than the upside. And if we held CBA stocks, and for the clients that do hold CBA stocks, we think it makes sense to take profit, particularly as it's trading around about $157 at the time of recording this video. So it's hovering around that 150 mark. We think that you can take some profit and then reinvest those profits in a way that's going to probably expose your portfolio to better returns. The next bank I want to talk about is Macquarie Bank. It's been a stellar performer. According to our independent research house, Lonsec, its returns to shareholders have been 16.8% over the last decade on average. That means that if you invested $100 in Macquarie 10 years ago, you'd have $500 today, more than 500 in fact, so more than a fivefold return, which is extraordinary. Now, it too is trading on a relatively high PE, about 21 times. And banks normally, one of the better ratios used is sometimes price to book, but in terms of inflated earnings, or inflated earnings multiples, I should say, it's good to think about the PE ratio. So it's on 21 times, so not as high as CBA, but its earnings growth has been significant. Just looking at my notes here, about over 9% per annum over the last decade. It's increased its profit or earnings. So again, it deserves a premium, and it's increased its earnings by a lot more than CBA. Even on a price to book ratio, it's relatively cheap, 2.4 times versus 3.3 with CBA. So we think if any of our clients hold Macquarie stock, we're quite happy. We're neutral in the stock. We think it's fully priced, but not overvalued. Let's talk about the bad news now, which is the other three of the big four, because we've spoken about CBA. Let's talk about NAB, ANZ and Westpac, because returns from those stocks have been, absolutely terrible. So NAB's returns over the last 10 years, 5.6%. To investors. ANZ was 4.1 and Westpac 3.9%. So really pretty ordinary returns. I mean, if you look at the dividend yield, that what dividends are expected to be paid over the next 1 to 2 years, the yield's pretty high on a grossed up basis. So if you include the imputation credits, about 7.3 to 7.7%. So some investors will sit there and think, well, I might hang on to these bank stocks because I'm getting north of 7% in terms of income. If I'm doing that, I probably don't need much growth. The problem with that approach is that, of course, the capital value can change. And those bank stocks are trading at relatively similar levels than what they were trading at in 2007. So that's 18 years of really no growth. Over that time since 2007, bank stocks have come down and then they kind of come back up again. So we think clients that own those direct bank stocks should sell them. Sell them and reinvest in an index or a different type of index, which I'll get to. We think you're going to position your portfolio to generate better returns than hanging on to those bank stocks. So that's the financial sector. Let's talk about mining very quickly. Obviously, we've got two really large miners in BHP and Rio Tinto in Australia, and they can have a pretty big impact on the index. They didn't last year. In fact, they were a drag on the index last year. Their share prices fell significantly. And these miners are really influenced mainly by three factors: demand for commodities, the price of commodities, and the value of the Australian dollar. And when I talk about commodities, I'm really talking about iron ore and copper, particularly iron ore. It's a big one for these companies. Now, iron ore prices over recent years have been north of $100 US per tonne. They're about averaging around that at the moment. But when you look at sort of longer term trends, that's relatively high. And you look at some analysts, they're thinking that actually prices might compress even further. So we've got some headwinds there in terms of commodity prices. In terms of commodity demand, one of the bigger buyers of iron ore, Australian iron ore, is China for its steel production, and it historically used, or in more recent years, used that to build property. But its property market is really challenging at the moment. So construction is down, and therefore demand is down as well. Also, iron ore dipped out last year, and China took the opportunity to increase its stocks. And so it has a lot of iron ore just sitting there that they've bought in their stockpile, increased their stockpiles. Copper's different though. Copper is used a lot by new renewable energies, to make solar panels, build electric vehicles, these sorts of things. So demand for copper is rising, and that's going to benefit both Rio and BHP, but they earn not as much as from copper in terms of share of revenue and share of profit as they do from iron ore. So that's kind of the main one. So a few headwinds there. Of course, the Aussie dollar is pretty undervalued, I think, at the moment. It's pretty weak. But that helps BHP and Rio. So when you look at their current values, they're valued on a forward price earnings of 11 to 12 times, pretty cheap. Arguably, all that risk is factored into the price. So the risk that China actually, reduces the amount of iron ore it buys from us, or the price depresses even further. I would argue, given that multiple, it's sort of factored into the price. Also, you're looking at a grossed up dividend yield of somewhere between 6 and 7%. So you don't really need a lot of capital return, particularly given we think the stock is relatively cheap and there could be more upside than downside, particularly from a medium-term perspective. So for clients that hold direct stock exposure to BHP and Rio, we're pretty happy for them to retain that exposure and nothing to do there. Now, one of the problems, as I said, is there's a big concentration risk, particularly in mining and financials. Mining makes up about 33% of the ASX 200 index, mining or materials about 19%. Now, if you took those 7 companies out, the 5 banks and the 2 miners that I just spoke about, you've got a much more even distribution, sector distribution from an index perspective, which I think something is something to think about. Now, Vanguard would argue, the second largest fund manager in the world would argue they're big for a reason. They're big because they're stable, they got a lot of profit, so this large cap concentration shouldn't worry investors too much. My view is that we should just be open to it. So it's not just about not investing in market cap indexing, but it's also really just about using different indexing strategies to accommodate some of the risk that, for example, the banks are going to be a drag on the index this year. I'm not suggesting they will, and that's not my outlook necessarily, but I think it's a risk, that the banks could be a drag on the index this year. And in fact, the miners, whilst they might not lose a lot of value from here, maybe they're not going to contribute a lot of value as well. So where are our returns going to come from? While I'm here, I'll just round out the top 10 because Rio's not in the top 10, but the other 4 companies, the CSL, Goodman, Telstra and Wesfarmers, were neutral on Goodman and Wesfarmers. We think Telstra is a perennial underperformer and we should take profit, particularly as it's trading sort of almost $4.50 now. We think it's time to take that money off the table. And CSL struggled over the last 5 years, particularly from a capital value perspective. We think strategically divesting or reducing exposure is a good idea. So what other indexing strategies would I employ given this analysis and commentary? Well, I'd look to try and dilute some of that exposure to those large cap companies. And so I'd use something like MVW, which is VanEck equal weight Australian index, or X20, EX20, which is BetaShares product that invests in the top 200, excluding the top 20, as the name suggests. And again, I wouldn't be putting all my money in there. I'd still keep some in traditional market cap indexing. You might throw in some fundamental indexing, so that's QOZ, BetaShares product, and then complement it with some X20 or some equal weight Australian, and building that Australian exposure out like that, just to accommodate some of those risks that the banks might end up being a drag on the index and the miners might not necessarily contribute a whole heap this year. Long video today. I just wanted to give you that idea. I'm publishing a podcast that goes into more detail in a couple of days' time, and hopefully you can check that out if you need any more information. Of course, we'll include a link in the comment section. Cheers.